Hello, everybody. Welcome back to Every Day is Saturday. I'm Matt Stahl, along with my partner, Brad Gatto.
Good. Well, it's afternoon. I was going to say good morning. It's afternoon as we record this podcast.
Yes, yeah.
How are you?
I'm well. How are you?
Good. I just have no idea why my brain just got stuck right there. I was like waiting for you to say something more, and I don't know why.
Well, I'm always anticipating what your response is going to be. So,
well, it was really good that time.
That was very creative. Good afternoon. You got the time of the day, right?
I did. Just so you guys know, it's 77 degrees in the Twin Cities of Minneapolis and St. Paul. It's going to be a high of 78 today. I'm just joking. I do this. I have a friend group, a college friend group. That's how I start all my messages every day, as I give them the full weather report in the Twin Cities.
I'm sure they appreciate that.
A lot of them don't live here, so
it's interesting.
Anyway,
topic of our conversation today, we've been going through the Psychology of Money by Morgan Housel, chapter by chapter, and sharing that with you and pulling out some interesting insights that we see from this. So we're going to pick up where we left off on chapter 15, which is called Nothing's Free. Before we get into that, what's new in your life?
It's summertime. It's baseball time. We're coming up on
your weather report.
Yep. We're getting to the point. I mean, it's almost 4th of July as we record this anyway. And so we got a little bit of a holiday break coming up. But I mean, otherwise it's fairly status quo, man. I think as of this week, we had a game Monday, a game yesterday, 2 games tonight, 2 games Thursday, a game Friday, 2 games Sunday, and then it starts again next week. So baseball is the answer to your question.
Baseball.
How about you?
That is status quo for the most part. Status quo over here as well. Soccer season is actually coming to somewhat of a close, which feels, when we have 4 children running around in soccer, it kind of feels like it's always going to be there, but the seasons are wrapping up. And one of our children is playing futsal. I've mentioned that on here before.
Yep.
One of our children is playing in the futsal nationals.
Wow.
Right after 4th of July. So
where's that?
It is in Kansas City.
Okay.
Futsal capital of North America. I didn't know that either. So
how do you get those titles? Like is that self-proclaimed?
That's proclaimed by me.
Okay.
I don't know if that's even their self-proclaimed, but that's where they hold the nationals.
You had me fooled.
They're big stuff. So yeah, this is his first year playing futsal and he gets to go to the nationals, which is really cool. And they have a good shot. So
you know what else is, when we ask about what's going on in each other's lives, it's good to give updates of hey, this is not normal. What's not normal for the Stalls is getting new vehicles.
Yeah.
It happens about as often as Haley's comment. And you just told me today you guys had to get a new vehicle because one of them busted.
We did, yeah. We took it to its end, which is what we typically do.
When you trade your car in, but it's to a scrap shop,
which that is the 3rd time that's happened to us. So we like to drive them into the ground. So
I love it.
So we fit in with all the other suburban parents driving around GMC Yukon.
Yep. So, yeah. You just went straight status quo.
We did. Yes. It's a status quo to the max.
I feel like GMC knows that that's status quo, which is why they cost what they cost.
Yeah. Yep.
Anyway. All right. Let's jump into chapter 15. Now, I got to say, this is the first time I was a little sad when you said we're in chapter 15, because that means we're almost done.
I know. It's
chapter
crazy.
20 is the last chapter of this book. So we're getting there, folks. But we are at chapter 15 today, which is called Nothing's Free. Now, on its face, I think we all know that.
Right.
And
Tin Stoffel.
How long have we been saying that?
Years. 15 at least.
Yeah, at least 15 years, which stands for what? It's an acronym. Matt.
There's no such thing as a free lunch.
No such thing as a free lunch. Everything has a price, but not all prices appear on labels. So we all know that nothing's free, but what about those hidden prices that we don't want to bake in? How in the world are we going to tie this back into financial planning and the psychology of money? Matt, take it away.
We are going to, but first we're going to start with a little story. So chapter opens up talking about General Electric. So back in
small little company,
just a little tiny one. In 2004, it was the largest company in the world. And
isn't that crazy?
Yeah, it is crazy to think.
Also interesting because in 2004, when it was the largest company, it was worth $1/3 of $1 trillion. In other words, $333 billion.
That's crazy.
I should have looked up prior to keep talking. I'm going to look this up while you're talking.
All right, let's do it. Largest company in the world, 2004. And most of us probably remember 2008, 2009. So we hit the financial crisis in 2008, and GE's financing division, which was half of the company's profits, just went into straight chaos. And in the end, basically, they eventually sold it for scrap. And the stock price fell from $40 per share in 2007 to $7 in 2018. And at the time, so
that's a lot. I mean, think about that. Think about that ride that people took from 07 to 18.
Well, it's bonkers. That's 11 years. So not only would you expect it to go up somewhat over an 11-year time frame.
Yeah.
Like take that into consideration too. Like it's a fraction of what it was.
Well, it wasn't exactly a bad time for, I mean, like, yes, we had the 08, 09 piece of that, but that's an 11-year drawdown. And to also put it in perspective, what I just looked up. So they were the largest company in the world, market cap wise, in 2004 at a 333 billion. Now the largest, I think it's Apple, because Nvidia's price has fell. I think Nvidia caught them for a bit, but 3.27 trillion is what Apple's worth today.
Jeez. That's crazy.
I don't even know what that means. I don't like
infinity.
Yeah, it sounds like a fake number. Long story short, GE had a heck of a run, a really, really good run to the point where it turned out to be too good to be true.
Yeah, glorious crash. Heck of a run and glorious crash. So the CEO at the time was Jeff Immelt. And so he was running the company since 2001, and all the fingers pointed to him. And so the plunging stock price, the dividend being cut, so on and so forth. So his insight on the way out is really interesting. So there's a quote: as fingers are being pointed at him, he told his successor, quote, "Every job looks easy when you're not the one doing it," end quote.
So I would like to tie a couple things into the story, because GE was kind of the bastion of consistency prior to this crash, if you will.
Yep.
Prior to that, their stock price was very consistent. Their earnings was very consistent. And it was almost too good to be true.
Right.
Is the way it felt. There's similar stories, right? There's the Bernie Madoff story. Right. Just these consistent returns every single year, always beat the market. You know, the volatility that you would normally experience in the market just wasn't there. There's that story that everybody knows and is familiar with. There's the Enron story. Same thing. Enron, just the numbers every quarter. They just consistently beat expectations, and there was just never a dip in that. And of course, the end of the Enron story is it was false accounting, right? And there was a lot of problems going on behind the scenes, but they were using a bunch of accounting measures to make it, from a public standpoint, look like there was no volatility inside of Enron. Same thing with Bernie Madoff. It was made up numbers. And a lot of that is exactly what was going on at GE.
Right. So
too good to be true.
Yeah. So the predecessor, Jack Welch, which a lot of us probably heard that name, talks about how Jack Welch, he was so committed to delivering. So if the quarter dividend was going to be 25 cents, he was so set on exceeding that, even if it was by 1 cent, that they would actually borrow from following quarters to make that happen, as far as corporate earnings go. So
the bottom line is, in all three of those scenarios, all of those companies that we mentioned, GE, Enron, or even not a company, but like a hedge fund manager like Bernie Madoff, are trying to give the illusion that there's no price, so to speak, to investing with us or with me. You're not going to have to experience all the pain of volatility and these sorts of things. And they try to make it look that way. The point of this chapter, when Morgan is talking about that nothing is free, is the price of investing. Right. Now, there's the obvious prices that we like to focus on, or people like to focus on, and that's like the cost of the mutual fund you buy, or the cost of an ETF that you buy, or something like that. Or maybe even you could look at it from the perspective of the cost of the advisor that you're using. But that's not what Morgan's talking about here.
Right.
What's he talking about?
So the cost that we're actually paying, that price is volatility, fear, doubt, uncertainty, and regret. So if you think about, if I'm a long-term investor and I hold on, I'm committed to holding on to that, I'm likely going to experience all those things along the ride, no matter what the numbers look like at the end, right?
Yeah. So it's easy. Like we all want something for nothing. We all want a good deal. We all want, you know, to get from a price perspective more than what we probably have coming to us. You know what I mean? And the market is no different. People want the returns of the market. Nobody is going to look at the returns of the market over history and be like, I don't want that. I'd rather just make 1%.
Right.
Nobody says that. They all want what the market offers. As an entrepreneur, that's the way I feel sometimes, is everybody wants the upside of what being an entrepreneur can bring. Starting your own company, being your own boss, like all these sorts of things. Everybody's like, they see the glorious side of that and the positive side of it without giving any weight to what it means to be an entrepreneur on the negative side. And so like the market, everybody wants what the market can do. They just don't want to pay the price.
Right.
And again, to reiterate what you just said, the price that Morgan's talking about here is the volatility that comes with the market. There's a price to pay for that. You have to be willing to take that volatility, deal with fear of when things aren't going well, the doubt you may have based on the investments you have, uncertainty, and any regrets, which is the benefit of hindsight. We always have regret of, gosh, I should have done this. I should have done that. In fact, I was just on the phone. Well, not phone call, but like texting with somebody the other day who know that I think I've talked about this on the podcast before. I have kind of a play account. It's not an investing account. It's a gambling account. I want to be very clear. Like I'm gambling. I'm messing around with some stocks. And one of the stocks I have, it's not a big account, but relative to the size of the account, a significant position in Rivian. And over the last 2 trading days, it's up 30, 40% because of one piece of news or information. Now, my buddies know this. And of course, they're all like living in regret of like, man, we should have done that. We should have bought Rivian. Now, what they fail to understand is that Rivian has gotten pummeled this year to this point. And so they didn't see any of the pain that I was experiencing watching all that money go away.
Right.
All they see is, had they bought recently at that pummeled price, that they would have gotten these big gains. And so the price of investing is that. If you want the upside, you have to deal with, if you want to be your own boss and you want to own your own company, you have to deal with all the other crap that comes along with being an entrepreneur.
Yeah. That quote about, well, it said in here, every job looks easy when you're not the one doing it, because the challenges faced by someone in the arena are often invisible to those in the crowd.
It's an even better example of that, like a homemaker.
Yeah.
The parent that stays home with a kid.
Absolutely.
Or stays home and just takes care of the house.
Yeah. You're just going to hang out with the kids all day. And
this is the easiest job in the world.
Yeah.
And they probably don't get the credit they don't get the credit that they deserve. It looks way easier from the outside.
Until you zoom in and you realize that you have this child unhappy over here and this one's yelling at this one. Similar thing. It's, if someone's looking from the outside at an entrepreneur and they think they have it all, they don't realize they just spent the morning dealing with an HR issue.
Yeah.
They're dealing with accounting, similar to investing. So
most things are harder than we give them credit for. Morgan says in the book, most often it's because we're not good at identifying what the price of success is, which prevents us from being able to pay it.
Yes. The example that we go into is, and I experience this a lot. If you look at a historical chart, Dow Jones, S&P, whatever index you want to choose, and if you zoom way, way out, everything looks great. It's this nice, smooth, gradual increase. It's when you zoom in, that's when you start to see the volatility jumping up and down. And that's what we experience. That's what we experience as investors, is that day-to-day up and down, depending on how much you pay attention to it. And so the example they give is the Dow Jones Industrial Average. From 1950 to 2019, on average, returned about 11% per year. That sounds great, right?
Which is awesome.
Yeah. What's the flip side of that, though?
Well, the majority of the time, and there's a graph in the book if you want to go get the book, the majority of the time from 1950 to 2019, which is a long period, right? It's almost 70 years where it's averaged double-digit returns. The majority of the time, the trading days was more than 5% below the previous all-time high.
Yeah.
So in other words, we saw a price of the Dow and it hit whatever number, 5,000. We're like, okay, it's hit 5,000. That you feel really, really good about it. But then all of a sudden it pulls back 5%, which is now it's going to be at 4,750. You're like, oh, that's terrible. That being said, although it averaged 11% over that almost 70-year period, the vast majority of the time that was true.
Right.
It wasn't trading at all-time highs. In fact, it was more than 5% off the all-time high. And then there's these random spikes where it's setting new highs. But that volatility of like you know, the feeling of like exuberance of I just hit an all-time high. Like I feel better that I just won a game I've never won before. And then all of a sudden you lose the next 5 games and having to deal with that constant emotional, onslaught is what he's saying is one of the biggest prices of being in the market, is being able to deal with that.
Yeah. And a real extreme example that he shares are Netflix and Monster Beverage Company. So Netflix returned 35,000% from
Is that all?
2002 to 2018.
I had something to do with that.
Yeah. I think a lot of us probably did. But
think about that, 35,000% over that 16-year period. And then the other example is Monster Beverages, which is 319,000%
from 1995 to 2018,
which is one of the highest returns in history. If we were to just pose a question, which company has produced some of the highest returns in market history? Nobody would have said Monster Energy drinks.
No.
That being said, those two companies in those periods where they were up 35,000% and 319,000%, it was still 94 to 95% of the time, depending on the company, that they were trading below their previous highs.
That's a wild ride.
That's crazy.
Yeah.
That's a roller coaster that everybody pukes on. Like nobody's making it off that roller coaster. It's just crazy. But that's what you sign up for.
Right.
Like that's the price to come into that party, is that volatility. But we don't like to do it. We try to avoid it. Right. Which is why you look back with the benefit of hindsight, like at a Bernie Madoff thing, you're like, well, obviously that wasn't real. But it feels so good to be able to get all of that, what he was offering, without the cost associated, that it allures us to the point of making bad decisions.
Yeah. It's too good to be true.
He uses the example of buying a car, and he says, basically we want a really good deal on a car. And the extreme example is, well, you just steal it.
Yeah. You either pay for the car or buy it.
Then I don't have to pay for it.
One, or you steal it.
But that's the equivalent of like trying to get into the market without the volatility of the market, is like trying to steal from the market, because the price of admission is it's going to go up and it's going to go down.
Yeah. So it's bringing that back to the specific investing side of things, going in and understanding that if it sounds too good to be true, then that's probably not true. There's going to be a cost of some sort. And you mentioned to me recently an interesting study about the highest performing investors. How about you share that with us?
Yeah. So Fidelity, and it's been a couple of years ago now. I don't remember the exact year, but in the last handful of years, they did a study and they were trying to figure out which type of investor at Fidelity. And of course, there's millions of people that have money on deposit at Fidelity, very large company. What type of investor at Fidelity performs the best, like gets the best average rates of return in their portfolios? The top 2 categories, and I'll start with number 2. The second best performing person or type of people was people that forgot they had money at Fidelity. They forgot about the account. And so it just sat there unwatched, untraded or, whatever. It was just sitting there as an orphaned account. They forgot about it. And they were the second best performing type of investor at Fidelity, only to be outperformed by, drum roll, dead people.
Jeez.
The best performing people were the people that involuntarily were paying the price of admission. In other words, they were just staying in the market. They got in and they weren't trying to circumvent the price of being in the market by getting in and out, by trying to tactically manage it away, or day trading, or going off their gut feeling of where they think the bottom of the market is, or whatever, magic potion it is that certain people think that they have. And they happen to win the game.
Practically speaking, they're not going in and out. They're not selling and buying. They're just letting us do its thing.
They're letting it ride, whether they know they're doing it or not. Well, they don't know they're doing it, but they're letting it ride. It is always, and it's funny because practically you and I have both talked to so many people over the years, and those are my favorite people when they come in and, maybe it's the first time they're hiring an advisor and they're in their late 50s, early mid 60s, something like that. And they'll say something to the effect of, well, I kind of forgot I had this account, and it grew and grew and grew and grew. But the ones that we watch just don't.
Right. Yeah.
It's like having that job where you love and the time just flies, and you look back, or you're like having a ton of fun and you're like, gosh, I can't believe it's been 3 hours already. But then you have that job that you hate, and it seems like you can, like, the second hand starts to go backwards. And it seems like it takes a day for an hour to tick by. What I would like to kind of end that thought with is, he says in the book, but the money gods do not look highly upon those who seek a reward without paying the price. Some car thieves will get away with it. Many more will be caught and be punished. And he follows that by saying, the irony is that by trying to avoid the price of investing, which I'm going to go back, I'm going to read it again. Here's the price of investing: is volatility. You have to be willing to deal with the ups and downs of the market, fear, doubt, uncertainty, and regret. So there's your price. And he says, the irony is that by trying to avoid that price, by trying to avoid volatility, fear, regret, whatever, investors end up paying double.
Yeah.
We talked about that in many past episodes, how the average lay investor trails or lags the market return. And it's because of this very thing.
Study after study. And so the ultimate question comes down to, why are we so willing to pay for the price of cars, houses, food, vacations, but we're not as obviously willing to pay the price of good investment returns? And the answer is because it's not obvious.
Yeah. It's not a check you write.
Right.
In fact, not only is it not obvious, and it's not like a physical check that you have to write. It is a check you have to write. It's just not a physical one. And the problem is you got to do it every day, right? If you're paying attention. It's one thing to write a check to the IRS once a year, and that's painful, or, that kind of stuff, if that has to be done. But like literally every day that you're in the market and the market's open, which is 252 days a year, I believe, you have to write that check of dealing with volatility, dealing with fear, dealing with the unknown, and all of that. And for a lot of people, it just becomes too much. And so they either don't go into the market and they choose just not to buy the product, or they try to get the product. And that's usually probably a better outcome, actually. And then there's those people in the middle that they still want the product. They just try to get it at some sort of discount.
Let me close things up by, so if you think about the price you're paying, the way you think about that is a fee rather than a fine. And you're paying a fee to participate in that. That is the cost. You're not being fined to do so. There's no guarantee of anything, but you are going to pay a fee no matter what.
Yeah. And changing that kind of the mental state or mental thought around that is one of the things that Morgan talks about being so imperative to being able to stay in the markets long-term, is not looking at it as a fine. Like, I just lost 20% of my money and that's a fine, but looking at it as that's the fee. That's, again, the price of admission. That's the name of the game. That's the way that this works. And if you want that long-term return, if you want to be that person that is 55 years old and selling their business that they started at 30 years old for $25 million and gets to retire on that, you have to deal with everything that entrepreneur had to deal with from 30 years old to 55 years old.
Right.
When there's probably nights that he's losing sleep and stuff that he missed out on with his kids and stressed out his marriage and just all those sorts of things, where the price of admission for that entrepreneur, just like being in the market, you just have to deal with the fact that we don't know what tomorrow brings. And there's going to be those ups and downs. He says in here, and I just want to read this word for word. It sounds trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. And it takes a while for them to work in your favor, typically. That being said, I think a good way to wrap this up, Matt, would be to tie it back to what we do and how we, why we do what we do. One of the things that we get comments on, we have the opportunity here at Fiat to do a lot of coaching and mentoring of other advisors. And so a handful of times a year, we'll have advisors from all over the country come into the Fiat office and do a couple-day training and learn kind of some of our systems and processes and how we, everything from operations to marketing to serving existing families and all that kind of stuff. And one of the consistent pieces of feedback that I get is that our planning process is very long, and they can't believe how long it is. Well, in dealing with this chapter of the book and helping people understand the price of admission to get in the market, there's a visit we have where when you think about the price and anything in life, in order to be able to buy anything you want, whatever the price of that thing is, you have to be able to afford it. It has to fit into your budget. And so going back to these volatility, think about that from a budget perspective. What's your budget for volatility? What is your budget for fear? What's your budget for doubt or uncertainty or regret? The answer to that is going to be, frankly, how an investor should be invested. is figuring out where your budgets are. It's the analogy we use all the time of, the best diet you could ever go on is the one you'll stick with. Right. So we have an entire visit that we call the interview, where we put all the numbers aside and we ask tons of questions just about who they are as people, their family, everything from their favorite beverages, which doesn't necessarily give us a budget for those sorts of things, but it's just good to get to know them. But then some harder questions like, what's the biggest financial mistake that you've made in your life, and how does that affect how you make decisions today? Well, in a lot of ways, that's going to answer some of those budget questions for us and actually tie back to a previous chapter we went through in this book. Morgan talked about how everything that's happened to us in our lives makes up 0.000, like 100 zeros, one of all the experiences that have ever happened in the world, yet they define 80% of how we think the world works. So it's important for us to understand that kind of stuff. And then we ask a ton of questions around how they feel about their money and what they want their money to do for them and all these sorts of things. In reality, this is really what we're trying to get at, is what is your budget for these sorts of things? Because I want to develop a plan that not only makes sense on a spreadsheet, which is another chapter of this book, the reasonable side of the life versus the rational side of life. So the spreadsheet, the rational side, how do we incorporate that with the reasonable side, which comes down to what can you afford? How much of the market can you afford relative to the price that you have to pay to be in it?
Yeah. Love it. That is,
well, let's just, I want to read one more thing as we close here. The trick is convincing yourself that the market's fee is worth it. That's the only way to properly deal with volatility and uncertainty, not just jumping up with it, but realizing that it's an admission fee that's worth paying. Find the price and then pay it. So once we find out whatever your price is or what your budget is, then we just have to pay it. And we have to understand kind of the rules to that game that we're playing inside of the markets. And so nothing's free. Understand the prices that you're paying, not just, we actually just previous podcast episodes just re-released how you pay your advisor. That's the quantifiable actual physical fees that you're paying to get advice. But on this side of things, what is the fee for getting into the market? What does that look like? What's the reality of the game that you're playing? Make sure you define that, make sure you're comfortable with it, and that it fits into the overall outcomes that you're seeking for your family.
Yeah. If you don't acknowledge that, you're going to be in for a wild ride. So,
well, as we know, the average lay investor doesn't do well.
Right.
And it's usually because they have no budget and they don't understand the game that they're playing or the rules to the game, so to speak. And those are usually the people that try to shortcut it as well.
Yeah.
Right. Awesome. Well, thanks for joining us for this episode of Every Day is Saturday. Thanks again. Big shout out to Mr. Morgan Housel for writing this book. It's almost 5 years ago now, I think. Is that right? This book came out?
He's written the second book.
It came out a while ago. Anyway, it doesn't matter. That's chapter 15. A little bit of a teaser. Chapter 16, which we don't do these every episode. So I don't know, 2, 3, 4 episodes down the line, is called You and Me. I'm not going to give you any context of what that means. It's just called You and Me. So you'll have to tune back in for that one. If you're listening to this and you've never really thought through the price of admission to the market and kind of what your budget is all about, and you've never gone through our interview process here at Fiat, I would highly encourage you to do so. It's not only a learning for us and how we might be able to help you, but it's a good learning for you and yourself and how your money is invested and kind of how your behavior shapes some of the decisions that you're making. So with that being said, feel free to reach out to us and try to get something like that scheduled. All of the information to contact us is on our website, a completely redesigned website, by the way. So make sure you check that out. Fiat, FIATWM.com. Again, FIATWM.com. I'm Brad Gatto, my co-host Matt Stahl, and we will see all of you next Saturday.
Thank you for listening to Every Day is Saturday. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Fiat Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.